So, shit's hitting the fan, you know? I mean, there's no really other way to put it. I really don't even know where to start. We can go over kind of like what the market's done over the last month. We can talk about what we're going to do in the future, but I don't know what's going to happen. So let's go back to where it all started. Usually, for a while I've been coming up here and doing these presentations, and I'm like, rah, America's great, buy everything, shut up, stop complaining, right? That's been me for a while. And then all of a sudden, things changed, right? So we had one of two choices coming into the month. We can either just ignore it and just not manage risk. Let's see what we're doing on time. Not manage risk and just buy every dip. That's one strategy. Or you can recognize that the data has changed. The weight of the evidence suggests that there's an overwhelming amount of supply relative to demand in stocks, and we can go ahead and raise cash and start shorting stocks. So let's go back to the beginning. So this is September 24th, right? Market's making all-time highs, and everything's great. Everything's fantastic, right? But there's always a but. It's always like, all right, we're buying stocks as long as the S&P 500 is above the January highs, right? The idea was, all right, Russell 2000, mid caps, micro caps are all breaking out to all-time highs in the spring. Those have been the leaders, right? So the weight of the evidence suggesting that there's risk appetite amongst institutions if the small caps, mid caps, micro caps are breaking out prior to the large caps, right? They're not betting on the smaller names because they're scared, right? They're putting money in because they want to be aggressive. That's a good sign, right? So the fact that they're making all-time highs was suggesting at the time throughout the summer that the large caps, S&P and Dow, would also break out to all-time highs. And then what happened? They broke out to all-time highs. Perfect, great. But we needed to hold those all-time highs. Otherwise, there is an overwhelming amount of evidence that, as it turns out, the demand has not absorbed all of that overhead supply from earlier in the year. And in fact, the sellers are dominating that particular level where we hit in the January highs. So the trade was basically, listen, we want to be long stocks. Everything is great unless we're back below the January highs. And if we do fall back below it, right? Because again, listen, any idiot could buy a stock that goes up. It's what you do with the ones that don't do what you think that is going to happen, right? How you manage risk, how you protect yourself. So while everything was great, we want to imagine what a world is going to look like if everything is not great, right? What if things change? And if we are back below the January highs, 2875 to be exact, it would set up a failed breakout. And the way I learned it from a good friend of all of ours, Brian Shannon, is that from failed moves come fast moves in the opposite direction. There's imminent downside risk, right? Bearish momentum divergences get triggered. And then most importantly, I think it's not even the fact that we're losing money in our portfolios if we are staying long under these circumstances. It's the opportunity cost. What else could we do with that money? So here we are, September 24th. If we break the January lows, all bets are off. And then look what happened, right? We're making new lows today. This is perfectly normal behavior, guys, right? Everybody wants to blame the president or blame interest rates or Ebola or whatever it is these days. And the fact of the matter is this is just perfectly normal behavior, right? We could not hold above those highs. So we want to think about where we can go moving forward, right? Great. What are we going to do about it? I still think there's an overwhelming amount of supply relative to demand. I think I've been saying it all month. I think crashes are possible in this sort of environment. I think there is literally unlimited amount of risk. So it's not so much that a crash is going to happen or that I'm calling a crash or whatever it is. The fact that it's even on the table, right, is reason enough all month to not be long stocks. And we're obviously seeing the repercussions of that failed move. So 27% correction back to those 2015 highs, I don't think is out of the question. We're going to talk about some of the things that we're looking for that would be evidence that we are not going to go this low. And in fact, we're going to have a more shallow correction. I was just searching. I was on the phone trying to check quotes. And the headline is, markets fall into a correction. Where have you been all month? What do you mean they fall into a correction? So we have now broken this 2660, but I think that if the market is going to crash and we're going to have substantially lower prices across the board, it's going to happen below S&P 500 2660, right? That's the key level. And if you guys are interested in where these Fibonacci numbers come, go to allstarcharts.com/Fibonacci. By the way, I'm JC, allstarcharts.com, check it out. I basically lay out, I'm an open book. There's no secret sauce, there's no secret formula. I tell you exactly what I do because I know you're not going to do it, right? So it's fine. We rip through 5,000 charts. We have a killer team. Bruni, Sean back there, everybody. You're not going to do the amount of work that we do. So we're an open book. So if you're ever curious, go to allstarcharts.com/education and I lay it all out. So 2660. So, listen, can the market rally from here? Sure. The market can do anything. The market doesn't give a damn what JC thinks, right? So this 2660 right here, this is the level. If we're going to get a rally, if we're going to be long stocks, right? If we're going to be optimistic, we're going to be bullish, we're going to be buying stuff, we have to be above 2660 on the S&P 500. Otherwise, it's extremely irresponsible in my opinion. So we can see something like this, right? Kind of like a bottom, momentum sort of diverges and we can get going and then ultimately break out. This is certainly in the realm of possibilities. I doubt it. This isn't the bet we're making. I don't think this is what's going to happen. In fact, we're making the opposite bet, but this is the way it's going to work. In my opinion, something like this in the best case scenario, and then we ultimately break out somewhere towards the end of the first quarter. I think that is as good as it's going to get, and I really don't think that's what's going to happen. I think we have unlimited downside risk, and if we're below 2660 on S&Ps, I stick to that. So we saw the same thing in the Dow, right? We said the exact same thing. If the Dow does not hold the January highs, all bets are off. And then we failed, right? Nice little bearish momentum divergence, right? And it's not happening at a random level. I encourage you guys, it's very simple math. Leonardo Fibonacci goes back like 900 years. Italian dude, he gets all the credit, but it was actually Indians from India that really did the math. Leo gets all the credit, the Italians, and the Italians love being like, yeah, that's our dude, but it's really the Indians. So these are the multiple Fibonacci extension levels from both the 2000 high and the 2007 high are both matching up at exactly where the Dow peaked. So where this correction is happening is actually at a very logical level. So how low can we go if we get back to the January lows, which I think is the best case scenario for the bulls? I think we break for sure. If we hold, that'll be a 13.3% decline, perfectly normal. If we break, the next level is right around 21,150-ish. That'll be a 21.5% decline. You'll get, you'll get the 26-year-old journalist who's never traded a stock in her life, being like, well, the market is now in a bear market, right? Because we broke 20%, right? When, this is the silliest thing ever, right? But that would be perfectly normal. When we start seeing headlines like that, where it's like, okay, now we're in a bear market, that's usually, time to be buying stocks, right? So I don't know. I think that's probably the reality. 21,100 is probably where we're going. We can go down almost 30%, get back to those 2015 highs, and again, would be perfectly normal. And I think that's really the risk. So the small caps were breaking out in the spring, right? They were the leaders. So it's like, all right, listen, small caps breaking out, mid caps, micro caps, right? The riskiest names are breaking out to all-time highs. Large caps got to be breaking out soon too. And they did. But because they were the leaders to the upside, if we lost the leaders, in all likelihood, the large caps would then follow. So 169 on the Russell 2000 small caps was the level, right? We laid it out. If we're below 169, there's unlimited risk, right? Bearish momentum divergences are confirmed, breadth divergences are confirmed. There's unlimited risk because those were the former highs throughout the spring. So if we're breaking out of a consolidation, that's perfectly normal in an uptrend. But if we fail, that is evidence that there's big trouble out there, right? Because now all these dead bodies are hanging above head. All these dead bodies that are now wrong, these are the quote-unquote bag holders, right? Any rally into that level, they're going to sell into you, right? There's overhead supply in the market for the first time in years, Prior, there has been underneath demand. You ever notice that when the market dips, buyers come on in, right? It's not like a conspiracy theory. That's just there's more buyers than sellers. Now it's the opposite. Now strength is getting sold into. There's overhead supply because these bag holders need to get out. So we're like, all right, if 169 breaks, there's unlimited downside. And then sure enough, look at the Russell 2000, absolutely crushed. But again, it's perfectly normal. From failed moves come fast moves in the opposite direction. So how low can we go? To me, we can get back down to 129. That's my target. The short that got triggered this week, where their first target was 151, that was hit and exceeded. So now that 151 was our floor, was our target. It is now our ceiling. So we only want to be short if we're below that 151. So I think if you have any sort of optimistic view in the market and you want to be buying stocks, I think it needs to come above 2660 on the S&P, above 151 on the IWM Russell 2000, or at much lower levels. Nothing in between. I think there's unlimited downside risk. I think we could walk in, Dow's down 2,000 points. I think that is absolutely on the table. And I'm hoping for it, in fact. So this is the Russell 2000, and correcting, I think this basket that I laid out here, I think that's probably where we're headed. There's some key levels somewhere between 117 and 129. I realize that it's a big window, but that's sort of the area. We want to look at the market kind of like a mattress, right? It's not an exact line. You got to give it some give. I think that's the area where the buyers most likely will show up. So we want to be covering our shorts at 129 on the Russell 2000. And then, there's no holy grail in this thing. You got to freaking rip through a zillion charts. I mean, you can't cheat. It doesn't work that way. It's not like, I gotta go with people, I only trade the S&P. All right. It's all the indexes that are all suggesting the same thing, right? Here it is, the 161.8% extension to the freaking penny of the 2000 high to 2003 low. Look where the NASDAQ 100 peaked, at a perfectly logical level. So I think a 21% decline to 148 on the Qs is perfectly normal. That's where we want to be covering our shorts. And then it's like, all right, JC, why is this happening? What is the catalyst? I don't know what reasons they're making up these days, but in terms of like the underneath the surface, like what is leading the market lower, it's really the most important sectors. Semiconductors, right? You can't have tech without chips. So if chips are, what does this look like? Does this look like a massive bottom, or does this look like a massive top? Right? I mean, it's not that difficult. So if we're below 1,200 on the semiconductors index, there's unlimited risk. I think we go down to 1,000 easy. Look at financials. Does this look like a massive bottom, or does this look like a massive top? So I don't know. I think there's a lot more downside to 23. So what's going to drag the market lower? The most important sectors in the world, semis and banks. So, right, so what's the worst case scenario? Sorry, but that's the best case scenario. If things are really going to get really bad, regional banks are going to lose the 2007 highs, right? Part of the obnoxiously bullish sort of a strategy or conclusion has to include regional banks breaking out of a 10-year base, right? That's a very bullish catalyst. The opposite of that is if that fails and we're back below the 2007 highs, not only are all those bullish bets off, it's the exact opposite. And we're seeing the same thing in the broker dealers. I mean, talk about the most important stocks in the world. These are the freaking broker dealers, the exchanges, right? Those are the 2007 highs. Part of the structurally bullish thesis is that both regional banks and broker dealers are coming out of 10, 11-year bases. Like, that is super bullish. The other end of that is if they broke out and failed, that nothing could be more bearish, in fact. So we're going to be watching those 2007 highs in both the KRE regional banks and the IAI broker dealers index. If we lose those, crashes are not going to happen in the market with those sectors above their 2007 highs. Stock market crashes are going to happen with those sectors below those 2007 highs. All right, so what are we looking for that's going to kind of change our approach, right, and make us more bullish, more constructive? We actually want to be buying stocks, not shorting them. We're looking at market breadth. This is not a stock market. It is a market of stocks, right? I know it's cliche and you hear it, but you forget, right? S&P, what did the Dow do today? we want to know what's underneath the surface. What are the stocks? So we look at the Russell 3000. The Russell 3000 represents approximately 98% of all investable assets in the U.S. equities market, right? So it's basically America. So what we like to do is we like to take that universe, and we want to find out if momentum, I look at a 14-day RSI, right? So if momentum is getting oversold, it's getting below 30, RSI goes from 0 to 100. If it's below 30, it's oversold. Stocks and uptrends don't get oversold. They get overbought, right? You always hear, oh, JC, I can't buy the stock, it's overbought. How can an overwhelming amount of buyers possibly be a bad thing, right? It's a good thing. But on the opposite end, when stocks are correcting in an uptrend, they don't get oversold. Oversold conditions are characteristic of a downtrend. So we want to measure what percentage of the Russell 3000 is getting oversold, is showing bearish momentum characteristics. So when we make new lows in the market, here we're looking at, this is 2016. S&P, Dow, everybody made new lows in January. On the second low in February, fewer stocks got oversold. So in other words, we were seeing breadth improvement that was not being recognized in the index itself. That was the low. Earlier this year, we made a low in January. We got a spike in stocks getting oversold, which is perfectly normal. We got a new low, and then almost no stocks got oversold. In other words, telling us that the internals of the market were already improving, even though you couldn't see it at the index level, right? The headline that they're going to write is, Dow goes up 100 points, 200 points. What they're not going to write is, Dow, blah, 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 fewer stocks got oversold, right? You're not going to get that, right? You're not going to get those breadth internals in the headlines. It's not sexy. It's dorky. But that's what we're looking for moving forward to suggest that the world is not coming to an end. The stock market is not going to crash, and in fact, we should be buying stocks. So we're looking for momentum breadth improvement for me to kind of reverse the script and be like, all right, let's buy these stocks. We haven't seen that yet. To the contrary, we're not even making new lows below the January lows, and we're already getting higher readings in terms of breadth. So not only does the market look like shit, but the internals of the market look even worse, and you're not even seeing it at the index level. And then in addition, the market's not even making new lows yet, but we're already getting an expansion of stocks making new lows. So again, the market itself, the market of stocks, is exponentially worse than you're seeing at the index level. So while everybody's freaking out about the market falling, it's actually worse than it looks at the index level. For you Dow theorists out there, when the Dow Industrials make new highs, the transports need to make new highs too, right? You got the companies that make the goods, you got the companies that ship the goods. And if they're not confirming one another, something's off in the whole system. We made new highs in the Dow, we made lower highs in the transports. So that is a big problem. And it's not just in America. How am I doing? You guys kicking me out? Yeah, you guys are kicking me out. So, I got time? Oh, good, because I got a lot of charts. No, just kidding. Can I get a drink? No. It is not just America. Everybody's like, oh my God, America is so great. It's going up. Stocks are going up. Stocks in America have been going up because stocks all over the world have been going up. It's not going up because of what's happening in New York or DC. Stocks have been going up despite of what is happening in New York and DC because stocks all over the world have been going up. But that is no longer the case. In fact, America was like the last man standing. So part of the bullish thesis this summer was like, all right, is this crazy underperformance in financials and in semis and in emerging markets and global markets temporary? And then we're going to get rotation back into those areas and we're going to continue to new highs? That was the bullish thesis in the summer. Or are we going to look back on this period and say the underperformance in financials, the underperformance in the homies, the underperformance in the semis, and emerging markets was a heads up that shit is about to hit the fan? That was the question that we were asking ourselves in the summer. As it turns out, it's the latter, and America is now catching down to the rest of the world, and the rest of the world is actually getting worse. So does this look like a massive bottom, or does this look like a massive top in the Euro Stock 600, which is the S&P 500 for Europe? Kind of a big deal, right? Then you have German DAX, right? This is like on the Mount Rushmore of stock market indexes around the world. German DAX, right? Big deal. Big bottom or big top? Looks like a massive top to me. Deutsche Bank might be one of the most important stocks on planet Earth, literally crashing. Are those the types of things you see in bull markets, or are those the types of things you see in bear markets? This thing is a disaster. New all-time lows. I mean, my data, maybe it was lower a million years ago, but for all intents and purposes, it's making all-time lows. If we're below 10 and a quarter, 10.30, I think we can short the hell out of it. I think you got a ton of downside, and if the world is coming to an end, Deutsche Bank will probably lead the world to the end. So if when the way, I'm lucky, I get to speak to institutions every day. These are the biggest funds on planet Earth, right? These guys have more money than God. There's actually a book about it, More Money Than God. You should read it, it's great. In many cases, particularly the long-only funds, they can't short stocks. They can't raise cash. They either have to rotate into different sectors, right? In their mandates, these mutual funds can't have more than like 3% cash or something like that. They're all different, but like almost nothing. And they can't short stock. They have to be long at all times. That's the job. So the way that they outperform their benchmark so they could get their bonuses at the end of the year is to rotate into more defensive sectors like consumer staples, utilities, healthcare when the market is falling. That's how they generate their alpha. And then when the market's ripping, they overweight the consumer discretionaries, technology, financial, sort of more of those risk-on sectors that are going to outperform in a bull market. So if we want to see what the market is doing, we want to see in particular the consumer staples, because if the economy sucks, we're still going to smoke cigarettes and drink beers and brush our teeth and watch. That's not going to change. So those consumer staple stocks are very defensive in nature. So if the market's going up, staples tend to underperform because of the lower beta aspect of it. And when markets are declining, they outperform because of their defensive qualities. So in this case, I took the consumer staples and S&P 500. I flipped it upside down. So S&Ps are the numerator, staples are the denominator. So they move with the S&P, as you can see. We had lower highs in this ratio prior to the peak in 2015, which is perfectly normal. We had lower highs in this ratio prior to the peak in 2007, again, perfectly normal. And then look what's happening now. So we've seen this story before, and it's led to substantial declines in the markets. Why? Because the long-only mutual fund managers are overweighting consumer staples because shit is hitting the fan, right? They got to get their bonuses. So we're watching that. So if you start to see, and by the way, so here is the staples on a relative basis on its own. So staples back as the numerator, S&P is the denominator, and we are breaking out on a relative basis. That is, things like this happen when stocks are falling, not when stocks are rising. So we want to watch, wrap it up. All right, real quick. So if staples start to underperform, that's probably happening in an environment where JC's bullish again and we're buying stocks. If staples keep outperforming, that's characteristic of lower markets. So this is what I was telling you. So what I did was I took the 40 largest stock market indexes in the world outside of America, and I equally weighted them. So to compare that stocks throughout 2017, they were moving together. Stocks around the world, S&P, everything's great. But what happened this year? New highs in S&P, and the world is not participating, and now we're catching down. So where's the money going? Precious metals, continues to do well. I still like it. Gold miners on a relative basis, they didn't just start outperforming out of nowhere. They started outperforming at the same level that they started outperforming in 2016. Again, perfectly normal. Palladium, there's not a lot of things out there making new all-time highs, like almost nothing, but palladium is. So listen, if we're above the 2000 highs in palladium, I think we could be long. Here's the ETF, 107. If we're above 107, I think we could be long. If we're not, all bets are off. And then finally, the last thing that I want to talk about is probably the most important thing. Quick, I know. The real market is the bond market, right? All these cryptos can all go to zero tomorrow and no one will care. All these pot stocks can go to zero tomorrow and no one will care, right? These are irrelevant markets in terms of the global landscape, right? Because they're such tiny little markets. So if you're a real institution with real money, you can't play in the little kid sandbox, right? You got to play in the big boy sandbox. And the big boy sandbox is the bond market. It's gazillion dollars. So if shit is hitting the fan, you're going to see credit spreads widening, right? The spreads between junk and treasury, the spreads between high yield and investment grade, right? Those spreads are going to be blowing out if the market's falling or pre-market falling. If credit spreads until now have been super tight, but guess what, right? So these are the spreads. I don't know why it says Palladium ETF. That's not right. So these are the credit spreads. So this is junk bonds versus treasury bonds, potentially putting in a failed breakdown. If this thing starts collapsing, that's happening in an environment where stocks are falling. These are junk versus investment grade. If this is collapsing, which it certainly appears like it's going to, Bruni, did you see this didn't even get overbought? That's crazy, right? So if this is collapsing, things are, that's a problem. And then finally, credit default swaps in the high yield bond market are spiking too. So for the first time in like forever, we're seeing stress in credit. And if that continues to get worse, which I hope and think it will, the markets are going to continue to collapse and we want to take advantage of it. So email me, say hi. Thanks, guys.